This makes me think of everyone buys gold to like hedge inflation, right? Because that's what happened in the 70s. It was like the biggest inflation. And it is sometimes still now, but there's time periods where it's not, right? It's not
Yeah.
correlated. And so it's like, okay, what's the difference in making gold and printing money then? You know, like we're
Right.
printing money, so the inflation's there. And so we're going to hedge that with gold, but now we're making gold. So it's like, okay, that seems counterintuitive to me.
Welcome to a Wiser Retirement Podcast. Are you curious about whether gold is still a good investment? I'm Casey Smith. Today I'm joined with Senior Financial Advisor Shauna Theriault. Each week we bring you practical advice on retirement, investing, and planning on your financial future. Don't forget to subscribe to the podcast wherever you're listening. Let's get started. Hey, Shauna.
Morning. How are you?
Doing good. I'm on a semi-vacation this week.
Are you on island time or where are you at?
I'm sort of on island time in Hilton Head, South Carolina. So I'm hiding in a corner of the house to do this podcast. But there's nothing more fun than a podcast on vacation week, right?
Right? And talking about gold of all things. Well, I love
I am on an island. So
Yep.
what a better topic than
Panning for gold.
or pirating for gold, right? I mean, there's a pirate ship in the harbor right now. It's I think you have to be under like 3 feet to ride it. But yeah, for the kids, Harbor Town here has a little pirate. Our kids did it many years ago, but no one's.
I can't picture you dressed up like that, Casey.
You don't dress up. You just get on, and they have a program for the kids. Let's be clear.
Well, that's not fun.
No, you will not see me dressed up as a pirate. That's not happening.
That would be fun. Halloween, maybe.
Probably not even Halloween. So anyway, I thought I'd start us off just talking about something I read in the headlines recently. And I actually did a blog on this, which I'll post shortly. So scientists at CERN, that's a European Research Center, they're probably best known. They have a particle accelerator. So all of our geeks will know what that is. But they've been able to successfully transform lead into gold. So they're able to change lead into gold. Think about that. Like instead of
but is it actually gold or is it fake?
Well, but they take the particles and they change the particles to make it into gold. So is it? I mean, and that's a great question because it leads me into my segue, which is think about diamonds. So diamonds, you have diamonds that you mine, but now they have diamonds that are lab grown. And until recently, you couldn't really tell a difference. You have to buy a new magnifying glass if you're a jeweler to figure out the difference between what's lab grown and what is. I'm not talking about cubic zirconia that are plastic. I'm talking about lab grown
diamonds. Yeah.
Right. So I did a deep dive into that too, and when I started looking at that, I said, well, why would you buy a lab grown diamond? And
it's not as precious as an actual diamond, right? I mean, if you think about that, I don't know.
I mean,
are they prettier? Are they sparkle more?
Well, here's what I did. I was curious. So I walked out of our office and I walked down the street to Wilson Jewelers on the square.
Did you?
Did. And I said, hey, I read this article about making gold, which made me think about diamonds. And the last time I was in here, you told me about lab grown diamonds versus regular diamonds. And he said, yeah, I had to buy new equipment so I could tell the difference. And I said, well, what are people buying? And he says, well, a lot of people are buying lab grown. And I said, well, why? Because it's fake. And he said, it's not fake. It's real diamond. It's just grown in a lab and versus Earth making it. And so he goes, I guess you can get more for your money. It's about 40% cheaper, but he says the prices are starting to converge in some spaces. So and he goes, yeah, a lot of the younger people want lab grown diamonds because of all the negativity around slave labor or cheap labor, poor working conditions for regular diamonds. So some people come in and say, I don't want to be a part of that culture. I want to just buy the lab grown
Hmm.
Or you get a little bigger diamond for the same amount of money, or the same size for cheaper. And if you look at the price of diamonds, other than in 2020, as more lab grown diamonds come onto the market, the price of regular diamonds have been declining. So that immediately made me go, huh. And of course, he knew nothing about making gold. So I immediately thought about, well, what happens if we start making gold? And I wouldn't call it I guess it is a lab. It's not like a diamond farm, but it's in a lab. And how does that affect gold prices? Because gold is it's a reserve for some countries, right?
Yeah.
So anyway, go and look at my article. It's linked to this podcast, and you can learn a little more about lab grown diamonds and if making gold to attain gold prices.
Hmm.
That's not what this podcast is about necessarily.
Isn't that this makes me think of everyone buys gold to like hedge inflation, right? Because that's what happened in the 70s. It was like the biggest inflation. And it is sometimes still now, but there's time periods where it's not, right? It's not correlated. Yeah. And so it's like, okay, what's the difference in making gold and printing money then? Like
Right.
we're printing money, so the inflation's there. And so we're going to hedge that with gold, but now we're making gold. So it's like, okay, that seems counterintuitive to me. I'm sure Andrew would have a really smart answer to that. Not me, or I always ask these questions because it's like the curiosity, and I'm not trying to put you on the spot.
If you supply more of something, then
It's less valuable,
right?
So it's like, okay, well, if you're making gold and you're printing money, it seems like, is it really a hedge?
If you're doing it at the same time,
yeah, that's what I'm saying. You're printing money, so it's like, oh, I'm going to buy gold, but you're making gold, so it's not really that valuable.
The money isn't tied to the gold anymore, so I guess they kind of run separate parallel paths there.
So it's just, I don't know. It just seems weird to me. So we need more gold to help people hedge against the printing of the money. I don't know. It's just interesting. Interesting thing.
I don't know. It's interesting times. We'll say that.
So do you want to talk about Weiser's position in gold in general? Because I mean, a lot of advisors feel different ways about it.
Yeah. When we start off with like the history of gold.
Sure.
So the idea is that like during times of economic turmoil, inflation, political or geopolitical instability, investors have typically turned to gold as a safe haven. I call it the fear trade. If you're fearful, that's something that you might add. You might add to your portfolio. It's more tangible than paper assets, I guess. I remember. I remember. So I think most of our listeners know I had a stint in aviation as a airline pilot, and I had to sit ready reserve one day, which basically means you sit in a chair in a dark room watching TV, waiting for something to break or an operation, something to malfunction in the operation of the airline, and so you're the backup pilot, you're the fill-in, right? And so it was, I don't know, it was late. It was like an all night thing. I was there at like 11:30 at night. So I had to be there till 2:00 in the morning. But I was sitting there watching, and of course, a lot of people in aviation are all from the military. So the military channel is like always on in the crew room. In the crew room, there's lots of TVs. So this one section I was in had the military channel on, and it was the only one that had volume. And it was I guess when we pulled out of Vietnam. And you remember there's these helicopters, and they were trying to take the last few of their families and trying to get to Navy ships, and they would land on the Navy ship, and then it would get asylum into the U.S. And so this guy had flown to his house in his military helicopter, picked up his family, and was flying to the ship. Mm-hmm. And it was one of those helicopters that has two blades on top, and it was not going to fit on the ship because the other smaller helicopters would land on the ship. People would get out and they'd push the helicopter into the ocean. And so this guy's coming, he's got his Chinook helicopter with the two blades, and he gets up right. He lowers his family down. And then you see him, the commentator's like, well, how is he going to get out of the helicopter? So anyway, he moves the helicopter to the side of the ship. He rolls the helicopter in a perfect form. He jumps out of the side of the helicopter. He goes right into the ocean. I mean, just disappears from of course it's very bad cameras and they're all shaky and everything, but he just disappears, and the commentator uh makes it kind of dramatic, but then he comes back up. And what had happened was he had sold, he knew this was going to happen. His family had to get out. So he sold all their material possessions and he bought gold bars. And he had gold bars in his backpack. But when he jumped out, he jumped out of the helicopter. He was too heavy to swim with the backpack on. So he had to take the backpack off, and the gold sitting at the bottom of the ocean still today in a backpack.
Oh, wow.
He had to swim to the boat. It's a shame they didn't have Bitcoin back then. He would have bought a virtual Bitcoin on his.
I don't know, but the computer wouldn't have lasted. So that would work.
So I think in times of like third world countries, when your country could go out of business or your currency could disappear, the gold makes sense. For us here in America, the chances of that happening are just so slim. But that's kind of that's how preppers feel about it, I guess. So anyway, enough of the stories. If I go back and I'll look at how gold performs in different market conditions. So it does typically do well in periods of high inflation. Did pretty well in 2022. The stock market gets really volatile in the short term. Gold prices will tick up, or obviously big sell-offs.
I mean, is that just because people? So that's the thing, right? It's speculative. So it's like there's no balance sheet to it. You can't see how it's really performing. It's just what people are willing to buy.
Yeah, you're just looking at price.
So it's like people just buying it because they're of fear, like you're saying, the fear trade.
You don't have any income from it. It's just price. Currency devaluation. So if the currency goes down, then gold will go up typically.
Yeah.
Gold does underperform at times when interest rates rise. Gold underperforms because gold doesn't produce income. So therefore it couldn't keep up with higher interest rates. If the stock market's really strong or investor confidence is high, gold will typically go up. And, we did see gold's kind of flat in 22, actually. The big run up was in 24, a little bit of run up during the COVID time period as well. So I looked and then said, okay, well, what's the correlation between gold and the stock market? So if you look at over the last 10 years, gold has really no correlation with the stock market. It doesn't go up, or it doesn't always go up when the market goes down. It doesn't always go down when the market goes up. It just kind of does its own thing. Sometimes it runs at the same climb as the stock market. It almost did that in 24. It was moving up along with the stock market in 24.
I mean, maybe that's just historically it's changed, because I looked up too, and I know we haven't talked before this, but I looked up too, like when has it protected against inflation? So in the 70s and the early 80s, gold was very effective in helping with inflation. So maybe that's what people are remembering because of what, who's living right now, right? It's before that, no one's, historically maybe paying attention. In the 1980s and the 1990s, it wasn't a hedge for inflation.
In 1980 to 1984, it was down almost 10% per year.
Yeah.
During that time period, and inflation was going up 6.4%.
Yeah, so it wasn't effective during that time period. In the 2010s, it was low. It wasn't effective during it. And in 2020 to 2024, it was like high inflation and it was mixed effective.
Yeah.
And so, the thought of, hey, this could really hedge inflation, it can maybe sometimes, but it's not always done that.
Just food for thought. For a super conservative investor who has very little equity allocation, it does have a negative correlation with short-term bonds, which I thought was interesting.
Oh, okay. And that's what we talk about too, Casey, right? Like that is the hedge for inflation. Is if now when you're retired, you can't have all of your assets and equities. That would be too risky, right? Because you need money to live off of when there's downturns. But being invested in equities is a hedge for inflation because they pass through increased prices to the consumers.
Yeah.
So, I mean, that in and of itself is a hedge. So to me, selling stocks to go into gold, you're moving from one inflation hedge to potentially another, but it's the bonds that get hurt with inflationary times, potentially.
Quick check-in. Have you thought about the legacy you'll leave behind? Download 7 Steps to Leave a Financial Legacy, a free guide from Wiser Wealth Management to learn more. It's not just about wealth. It's about leaving a lasting impact. Go to wiserinvestor.com/guides to download your free guide today. Now let's jump back into the episode.
If you look at the S&P 500 over the last 10 years, gold's up 171%. That's the 10-year return as of yesterday. The stock market's up 228%.
Yeah.
After this tariff sell-off.
Mm-hmm.
So the stock market most likely it was way ahead up until the tariff sell-off. Now, gold sold off too in all the tariff news, but not as much as the stock market did.
Which is kind of like counter what everyone talks about, right? Because you would think, okay, tariffs, prices going up, I need to buy gold to hedge inflation, but gold went down.
Right.
So it's not acting like it did maybe in the 70s and 80s.
Maybe not. But it's also different problems today than what we had back at that time. I think the biggest issue I have with gold is it just doesn't generate the income that other asset classes will. So therefore you have to time it. So would you buy gold now when it's only 5% off its all-time high? Is now the time to be buying gold? I don't know. You have to be market timer with gold. And you know what I used to tell people is that if you're going to buy gold, then you should you should buy it and put it in your vault,
not your backpack.
That
would be bad when you're jumping out of the plane.
That's really bad. But honestly, I started researching that, and when you buy gold, you have to pay 1 to 5% above the spot price. So the spot price is $350. You're going to pay the dealer 1 to 5% more for it. If you buy a smaller quantities, like less than a bar size, you're going to pay 10 to 15% more for the premium to buy it. But then when you sell it, it's 2 to 10% less spot price. So it's almost kind of like a old school A-share mutual fund. You buy in, you're going to pay 4.25% to get in. But gold, you're going to pay 1 to 15%, depending on how much you're buying. And so you're negative. Let's say it's 3%. You're negative 3% from the start, and then you have to wait for it to rise 3% to get to your purchase price break even. But then if you sell it, you're going to lose, 2 to 10%. Let's call it 5 on the sale in a transaction fee. They don't really call it a transaction fee. It's just the price they give you. So there's a bid and there's an ask, I guess, kind of like how a stock would trade.
Right.
So not only this is not something you trade frequently. It's something you buy, and you have to have a long-term conviction that this is going to be here for the portfolio. And the problem that I have, you and I have been doing this. I won't tell people how long you've been doing it. I'll tell people I've been doing this for 25 years.
What? You think I'm going to be offended?
Just say a girl's age.
Gosh, she's old.
I don't want to back into it.
Well, I started young, so that's fair.
That's right. You started when you were 12, and you've been doing this for 20.
And you always say I look 35, so it's fine.
Oh, I said 25.
Well, good. Well, now they know you're lying.
That's right. So if you start back even in like 2015 is what my chart goes back to, you did nothing for so long. You went 5 years with not much of a return.
Sounds like bonds to me.
Right. So sounds
like costly bonds.
I would just say, what's the opportunity cost? And whenever we have a new client come in that has gold, I never see it be like 3 to 5% of our portfolio. It's like a ridiculous number, like 30% in gold. These aren't advisors.
They're scared because it's like, can 5 to 10% really make a big difference anyway? So you'd have to buy enough to make a difference. And then, but it's so speculative. And to your point, it doesn't have the growth potential. I mean, maybe it's more of seen as a hedge for a downturn. So to me, it's like bearish.
I go
Bearish.
back to I go back to if people were more educated about investing, would they feel the need to buy gold?
Right. Or using a bucket system like we talk about all the time,
Yeah. Like if you it's just like annuities. If a person was educated about investing, like we sat down and we took them through like Wiser 101 on this is how markets and portfolios work and this is how you protect yourself from volatility, would we even have to, we don't sell annuities, but would anybody ever do this and say, no,
consider them.
I didn't
Yeah.
go with Wiser, I bought the annuity. Would that ever happen?
Well, it's interesting you say that, because when I explain, whether in a client meeting or a prospect meeting or just in general, the idea of having enough set aside to spend when the market's being somewhat volatile, and then being in, high quality stocks for the growth portion and how that functions. And they have annuities, or like, you kind of create, for lack of a better word, your own annuity by making an income stream that you don't have to pay for. Like, you don't have to pay somebody 3% to create your own annuity stream and have your money locked up, where you can take distributions. As long as you structure it properly, it should last. And as long as you're not withdrawing too much, it should last, So when you explain the whole concept of that, and still participating in the market, but having enough set aside to live off of, they're not scared, where they feel like they have to put it in an annuity stream so it lasts for them.
I had a prospect call in. It was a 5:00 meeting, and I was exhausted from some pretty intense meetings earlier in the day. I think 3 of them actually.
Yeah.
And I didn't have much patience with him. At least I didn't feel like I did. He seemed appreciative at the end of the call, but he was trying to, his whole premise was he was trying to figure out how to liquidate his portfolio. And he wanted to buy physical gold and put it in his house. And I'm like, I don't know why you would do that. He's like, well, I just sense the market's going to fall apart. And I'm like, this is a blue collar guy.
Yeah.
Just working every day, no formal education, definitely not business school. And there's nothing wrong with that. We have a lot of clients that are like that. They just trust us to do what's best with their money.
Yeah.
And but yeah, he was actually trying to do that. He's like, so you don't think the markets are going to just fall apart? And I said, even if the markets do fall apart, you're better off in the stock market than you are putting 100% of your wealth in gold. It's like, how are you going to take that gold and purchase things and buy things? And how's that gold going to generate income for you?
And you're going to are you going to bring a chisel to the grocery store? Like, how does that?
It's like, I don't know. You wanted everything.
If we're there, we have bigger problems, right?
I know, right? And
we're chiseling stuff to pay for goods at grocery stores.
And of course, he got a little political in the conversation. I just kind of tell him it doesn't matter who the president is. It's Delta's going to still sell you seeds. Coke's going to still sell you soda. Airbnb still going to rent you a house. So I just don't. If you have gold in your portfolio and it's a diversification play, you haven't done poorly, and I would not fault you for that. But I think it's got to be a limitation on it. Like I would say no more than 10%, and probably no less than 3%, because you want to make a difference in the portfolio. Yeah. Now at Wiser, we don't do that. We're not big active traders, and I think you have to be an active trader of gold to make a big difference in the portfolio. My father-in-law, he bought every coin on late night TV. He would buy one of those things. And when he passed away, my mother-in-law sold all that stuff back to the coin shop. He had all the receipts attached to each one. Didn't make a dime.
I was going to say, would he be better in the market? Probably. That's where it's like,
didn't make a dime. So, he's been not been with us for 10 years. So it was probably 2 years ago that she did the liquidation. So she probably been a little better off now, but anyway, I wouldn't say, oh my gosh, there's gold in your portfolio. That's horrible. Why would you do that? I think just moderation inside a portfolio kind of makes sense. If it, and, but it's only going to help you in certain time periods, and it's going to go dark for a really long time. They're really no different than commodities. We had commodities in our portfolios for a decade and did nothing for us. And in the end, I was like, you know what? We're better off in the S&P than we are in commodities.
Yeah.
And we made a switch a long time ago. We made that switch, but there are other alternatives to physical gold. You can buy the ETF, which is GLD and IAU. Those are the two most popular ones. And when you buy the ETF, you eliminate this whole spot price thing. The jeweler or the guy at the gold shop, coin shop, with those large spreads. There's still a spread, but it's a lot tighter in the ETF. But if you're a doomsdayer, you don't want to buy the ETF because that ETF is not going to help you if the whole world falls apart and there's zombies running down the street. So in that case, you're going to need the physical gold and you're safe, right?
I mean, but physical gold, to your point, you have to insure it, you have to protect it, you have to move it. I've heard of people selling their whole portfolios and buying just truckloads of gold. And it's like, how do you protect yourself in that? And where do you put it? And
well, that's where the guns come in. You got to have the guns.
Right. You
don't leave the house ever.
That's just
the safe, waiting for them to come.
That's drastic, right? But, selling everything and going into one thing is just drastic in general. That's just burying it in the backyard. That's just drastic, right? But it's still, no, we didn't even talk about, you talked about the entrance fees to get in and the entrance fees to get out. But what about the taxes on it too? It's a higher tax. It's taxed at 28% capital gains rate instead of the standard 15 and 20% capital gains rate if it's held long term.
Yeah.
So, it's higher taxes too, which again, it's not really the play for it to appreciate. It's really to protect, the principle is usually why people go into gold. So, so that you don't have a downturn, or then when prices are high, it helps combat that, but it hasn't always acted in that way. And so if you're looking at it for appreciation, it's not really that type of investment, I don't think, in my opinion.
If you want protection, you want U.S. short-term treasuries. That's what you want. If you go and beyond that, again, if you think the whole world's going to fall apart and you're going to move out and live on the grid, then I guess gold kind of fits the lifestyle, I guess, somewhat. But I don't. Like I said, if you had it in your portfolio and you bought one of these ETFs, you haven't done poorly in them. But you went several years, 5+ years, where not much was happening and you were being left behind. Do you have the patience to deal with that? To look at keep looking at that goose egg in the portfolio. I don't know.
Well, to your point, if it is stagnant like that, if higher prices, if prices are rising and the cost of everything is going up, then you're not keeping up with that anyway in that investment. Yeah. Maybe during times it does, like the 70s and 80s, and occasionally, the couple of years that you mentioned, but I would think that would hurt you in the long run, especially with the prices to get in and out of it, right? Especially with the higher taxation potentially if it does actually grow. And if it's not participating in an increase like that, how are you going to keep up with inflation with it? So, I'm just not a huge fan.
The other part too is you could buy gold mining stocks. So that would generate some type of income. It's within the industry, but it's not buying gold directly.
I would think those have K1s. I would think just like the gas and oil lines.
You're introducing manager risk at that point because now the company did not manage itself properly, and you have additional risk. So,
if we do like this whole creating gold, will those even be profitable for mining in the long run?
You have to read the article to find out, but I don't think they could make enough gold to do that.
Potentially.
Yeah.
It's just a changing world, it's like we're doing.
I also don't want to be hypocritical because we say we don't buy gold because there's no income, but yeah, we own Bitcoin in our portfolios.
That's fair.
We have Bitcoin and Ethereum. So what's the difference between buying Bitcoin and Ethereum versus buying gold?
Maybe the changing of the times. You're getting in at I don't want to say early. It's not early. It's early in an ETF.
Oh, yeah, I think it's early for Bitcoin.
So you're getting in during the time period when gold was just exploding, like in the 70s. So we're starting Bitcoin, right? So maybe it's a play from that standpoint.
And was it the 70s? I thought it was like the early 1900s when people moved
I don't know.
California to mine for gold.
This is where Andrew's the data king and I'm not.
Well, yeah.
You're probably right. The gold rush was a long time ago. Math is great. History is not.
Bitcoin and Ethereum, I feel like we're at the beginning of something new.
You're right.
Something that Robert and I talk on the podcast quite a bit about is
right
how this gets used in the future, what the future of digital transactions look like, where gold's not that. So I see Bitcoin and Ethereum maybe more of as a technology play versus it's not a fear. We're not buying Bitcoin and Ethereum out of fear.
No.
Some people would buy Bitcoin out of fear though, because Bitcoin, the whole reason it was created was because of the financial crisis. They didn't trust the world banking system anymore. So they created Bitcoin. That's what it was supposed to be. You can do all the stuff through Bitcoin and you don't have to be involved with the world banking system. So, I don't know. I just want to note that because not all of our clients have it. About 16% of our clients have
of the Bitcoin. Yeah.
So, but it's, there's some similarities. Some people call Bitcoin the digital gold.
Yeah.
It's a lot more volatile than gold.
It certainly is.
But I would say if you're talking to a 20 to 30-year-old right now, they're not buying gold. They're going to be buying Bitcoin. Where if you talk to a 70 to 90-year-old, they're buying gold.
Right. But right. So is it the changing of, changing of times or changing of a new generation? And so that's what gold is. It's just demand for, that's it. And that you could say that about any stock though, right? It's like, okay, it's demand of their product is, but you can't see how it's performing. You can't see how the CEO is you can't see if it's profitable. It's just more speculative in nature. And so if the younger generation and the up and comers aren't buying it, eventually, will that shift or, it's remains to be seen because they're buying Bitcoin.
Right.
They've adapted.
I've always wondered that, like, who decided gold was like gold? Like who decided that this was precious? I don't like diamonds. Like who decided this is going to be really valuable? Like who's to say fool's gold isn't valuable?
Right. Right. I don't know. I hear you. Whoever they are, they decided, and we're just the people following who they are.
The very beginning of time,
Casey.
The very beginning of time, someone decided all this stuff is valuable.
Because we're just doing what we're told. Like, it's kind of scary, actually.
Right.
It's like, really, is it valuable? Is it to you valuable? I don't know. Because I can tell you what, my girls like silver. They're like, I don't really like, well, I have one that likes gold, but they don't like, it's all about the color. It's not really about the rarity of it. It's what matches with the outfits, right? So I don't know.
Right.
What matches with the skin tone is what matters. So I don't know that they care that it's real or not.
All right. Good conversation, Shauna. Thanks for listening to today's episode. If you're interested in learning more about Wiser Wealth Management, want to schedule a consultation, meet one of our fiduciary financial advisors, you can do so by going to wiserinvestor.com, where you click on the link in the episode notes. We'll see you guys next week. Bye, Shauna.
Take care.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening. That way you don't miss any new episodes. We'd also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. This podcast is strictly for informational purposes only and is not to be considered as investment advice or solicitation to buy or sell any financial products, securities, digital assets, or any other investment vehicles, or a basis to make any financial decisions. Wiser Wealth Management Incorporated is a registered investor advisor with the SEC. The host and/or guests may personally own securities, digital assets, or other investment vehicles mentioned on this podcast. Neither the host nor guests of the show are compensated for their participation, and no referral fees are paid to or received by any host or guest for clients, listeners, or similar interests. Investments involve risk, and unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor, tax professional, insurance professional, and/or legal professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.